strategist at Desjardins, as we take a look at the early trade in North America. And Tiago joins us now. Thank you for coming in, and Happy New Year.
Yeah, absolutely. Happy New Year.
One thing that Canadian investors and Canadians generally are wondering is this the year that the Canadian economy, which has been slowing fairly dramatically through 2024, actually hits recession territory? What is your call?
Yeah, so I think our view is generally that when you run through a bunch of different scenarios, there's a lot of uncertainty going into 2025. Under most of those scenarios, with the right amount of easing from the Bank of Canada, Canada can actually avoid a recession. This is still our view, and I think that, the Bank of Canada has done a good job of front-loading a lot of its easing. We've seen a lot of rate cuts last year. I think going into this year, we're not going to see as many, but we're still going to see rate cuts throughout the year, and a lot of that just reflects these headwinds that many people are aware of in Canada.
How slow will economic growth get? Where will we bottom in terms of quarterly economic growth?
Yeah, so a lot of that depends on the clearing of trade policies and whatnot in the U.S. Our view is that depending on when tariffs, if they get implemented at all, might actually be a benefit for Canada near term, as some companies try to front load ahead of implementation of tariffs.
Right.
So it's tough to pinpoint a number right now, but it's one of those where the timing of any trade policies matters a lot.
And on tariffs, I mean, if the Trump administration does what he has threatened to do, does that alter your call on no recession?
Yeah, so if we get this worst case scenario where you end up getting a 25% tariff implemented across the board, I think that it makes it very difficult to avoid a recession. But scenarios in between where you get a 10% tariff or certain goods get exempt from it, then I think that makes the no recession call still a possibility.
So you've talked about the aggressive easing of the Bank of Canada. That's one big reason the Canadian dollar has swooned in 2024, and very much so in late 2024. What is your call on the Canadian dollar in 2025?
Yeah, so I think in terms of from a near term, maybe over the next quarter or 2 quarters, the positioning seems a bit stretched in the Canadian dollar on the short side. There might be some scope for it to rally, but I think as we go out towards the end of the year, I think there's scope for further weakness there. And the Bank of Canada has acknowledged this to some extent. We've seen it in their meeting minutes where they've pointed to monetary policy having some impact on the currency depreciation. I think that's largely fair. The other side of it is really we've seen just a broad U.S. dollar strength, and that's something that's outside of the Bank of Canada's control.
Right. Do you believe that the weaker currency can result in us quote unquote importing inflation as goods from the U.S. become more expensive with a weaker Canadian dollar? Yeah,
I think the degree of depreciation that you would have to see for that to start to work its way through to the numbers in Canada would have to be fairly large. I mean, we've seen a large move so far, but I think we would have to see something north of, call it $1.50 on U.S. dollar CAD for us to start to really have that conversation.
What's the flip side? We always express the loonie in terms of U.S. cents per Canadian dollar. Are you able to do that conversion?
Yeah, so I think that would be closer to below 65 to 60.
Right.
Think,
so you don't see us getting there, do you?
Depends on the scenarios that we end up seeing. If we see the worst case scenario where we end up getting this 25% tariff across the board, I think it's a possibility that we get there.
Okay. What is your call on the U.S. economy? And that's important to us in a number of different ways. And one of them is that it affects the strength of the U.S. economy, affects what the Fed does, and that affects us in terms of the currency and other factors as well.
Yeah, so I think for the U.S. economy, we still have it's performing fairly well relative to the rest of the world, but we do have it slowing throughout the year. Our call for Fed easing is actually a bit more aggressive than what the market's currently priced in. I think based off of what we've seen so far, the market's kind of gotten ahead of itself a bit in terms of how hawkish it's been. I think that we should be looking at the 2 rate cuts that are priced in as a minimum, as opposed to the base case.
So with all of that macro stuff in the background, what is your call on equity markets this year?
Yeah. So on equities, I think that history, we have to look at what's happened over the past 2 years and really say that we've seen stellar performance.
Yeah.
I don't think that necessarily continues going into next year. I think the general view here is that we still see positive returns, but maybe slightly below average. A lot of that's just a function of the uncertainty that we're seeing with all of the things going into next year. So near term, I see kind of as we go into Q1 and Q2, entering inauguration, we get a better idea of what policies kind of get implemented on the U.S. side. We'll probably see a bit of choppiness in markets, but thereafter we can kind of start to refine our view a bit on where equities go. I think that's honestly the best that we can say at this point.
Below average sounds like something in the mid-single-digit percentage advances. Is that correct?
Yeah, exactly. I think anywhere between 2 to 5% seems reasonable, with some upside risk on that call, I think.
Tiago, thank you very much.
Yeah, absolutely.
Tiago Figueiredo is macro strategist at